Good afternoon, everyone. Welcome back to Short Verticals. Brett Crowther here with you for another good event today. Hey, we got a lot to talk about. In fact, what I'm going to do today is I'm going to cover something that you all have been asking for, and that's rolling verticals. And I think this is a great topic to discuss because I see so much misunderstanding about what it is, what it means to roll a vertical, and how does it impact the trade? Does it make it better? Does it make it worse? I mean, we'll walk through it, okay? It's a little bit of a complicated topic, and so bear with me as we go through it, but I think it's going to be very, very enlightening. And so I want to thank you all for being with me. Ricebird, hey, how you doing? Scott Luck, Richard Judge, good to see you, Richard. Tanya, Tasty Man, there's a Speak Truth. There's a couple others. I can't read some of those longer names and stuff. Anyhow, thank you for joining me. By the way, got Kevin Horner helping out on chat. Thank you very much, Kevin, for taking care of everyone out there on the chat. And so it's going to be fun today. By the way, I have a question to ask. In fact, I'm going to throw out a poll here in just a minute after I cover the disclosures, but we've had a debate about my shirt that I'm going to get to in just a minute. Let's cover some disclosures first, though. We'll get to that. So do remember that options do carry a high level of risk and are not suitable for all investors. Information here is for general informational purposes only, should not be considered an individualized recommendation. Paper money is for educational purposes only. Any of the trades, everything we show is hypothetical. Short options can be assigned at any time. Please be aware of that. Regardless of whether they're in, at, or even out of the money, it can happen. Investing does involve risk, including the loss of principal. Past performance is no guarantee of future results. And then here's the definition of your options Greeks. Probability analysis, when we talk about that, they're theoretical in nature, not guaranteed. Also, stop loss orders are not guaranteed to execute at or near the activation price. And then stop limit order, we covered that. Just we don't tend to put stop losses on there, but just know that. All right, so let me bring up think or swim, and then I'm going to come back to something. So we had an argument, not an argument, a discussion with me and the producers about my shirt. I said it's more of a Mountie Acorn one, and they said it gives off a Hawaiian vibe. And so I'm going to throw a poll out there and you got to let me know. What do you think? Does it give off a Hawaiian vibe or not? And if not, then we'll go with the kind of the I thought it looked like an acorn. That's when I bought it. I thought that, but apparently the discussion is on, and I'm not winning it at the moment. So we'll see what you all think. I want to know what kind of a vibe does this shirt give off to you? And this will tie it back to something else in the very end of the session. So hang tight as I explain that at the very end. But let's talk about the market, okay? This is very important. Where has it gone since last we met? Well, it was May 21st last we met. So it was right about there. We saw it bouncing off the support level. So let's kind of zoom in on this and make sure we get our feet wet on the market analysis. Well, it was bouncing off support and climbing higher. Now, what has it done since this time, since we met last week? Well, it's pretty much gone higher, right? I mean, it had one little blip of a down day, but really just continued on up and up and up it goes. Now, mention that it's a little bit of a slower pace than it used to be, right? I mean, this was just astronomical from March over into mid-April. That's a really steep climb, one that doesn't tend to hold that long when stocks climb that fast, especially when the overall market climbs that fast. And then it's taken a little bit of a slower pace, which can last for a bit longer. Now let's check out some of the other indices. We got the NDX, looking at the NASDAQ here. This one's still on one of those more, should we say, orbital trajectories. I mean, that is like going almost straight up. And then we have, another one kind of taking off after just even a little bit of a flag pattern, if you will. Just a little bit of a breather. Usually that's not quite enough of a breather to really kind of give it time to rest its legs. And this is where those Fibonacci's come in, where you're looking for that 1/3 to 2/3 pullback on the full run. And so this retracement right here, this little bitty retracement, let's zoom in on this little bitty retracement, again, isn't quite enough to really say, okay, it's had a reprieve, its legs have, been able to recoup and it's time to go. It's almost like when you're lifting. I have a gym here in my home, and, I always look at different ways to lift, and they always talk about how much time do you give in between sets, right? And if you're giving it only like 30 seconds or less, it's not enough time for your muscles to really recover. You need to give it closer to a minute to 2 minutes for your muscles to recover so that you can then challenge them again. Otherwise, you're still challenging them with the results of the first set, And it's kind of like this here. It hasn't really recouped yet. The muscles are still sore or tired, kind of fatigued. And so going into this is almost like it really didn't happen much at all. And so that one may not be able to last as long from a theoretical standpoint, right? Now let's just check out the Dow DJI. Let's get that in there. And the Dow maybe not quite as strong, right? I mean, this was kind of interesting. In fact, let me throw a channel on this one real quick. And we see a channel coming right through here. If we pull that up right there, it's almost like we're gonna have to go all the way up like that. So there's our channel. It does have that old high that it's right up against. Let's draw a line across there and point that one out. So that's an old high right about this ballpark that we're kind of sitting right at. It looks like it's kind of broken through and it's just sitting on top of that. Really not doing a whole lot, but still easing its way higher. I think is the best way to describe it. And when it eases its way higher, that's one that can last for a bit. Some may argue this is a bit of a cup and handle. I don't totally see that. Some are a little bit more of a purist, like I am, I guess, in my own mind here, about looking for that cup and handle where we see the cup. Is this going to be able to draw? It was acting up. There we go. Like a cup and a handle, except for, it's really, whoa, where did that all go? That disappeared on us pretty quick. Let me change something real quick here. Let's draw it one more time. So there's the cup and the handle, something like this. But I mean, it's just such this handle part really isn't making it work, right? And so here's what we're looking at right here, with the overall cup and handle going out. But if it does break that, if it is able to drift on higher, we could look at it go from this level down to about, wherever that support is down there, 45,000 to about 5,000 points to the upside. So up around 55 could be a potential target area, based upon, that cup and handle, which I don't see it as being a real strong one because of usually on the cup and handle, we like to see it run up, bounce significantly, and pull back. Again, that about one third of that prior move. Just out of curiosity, I do want to see how far this one did pull back. Let's just throw some fibs on there and just get an idea from this low right here up that high. We'll put it even right there. Yeah, see, we didn't even make it down to a third. We have too much going on here. Let me remove some of these things. But when it bounced off here, it didn't even come back. We're looking for it to come back in this ballpark right here, which it did not make it down to. So it's no, not quite enough, right? All right. So where does this leave us? Well, it leaves us with an overall bullish market. It's continuing to climb higher, and therefore we're going to continue to look for um, bullish moves. Let me just see here. Just a lot of things come in. Quite the detailed assessment of shirt. Okay. And let's see how to close the poll if I can find it. Let's just see what the results are real quick. On the poll, it's still going. Looks like it's still bouncing around. We'll give it another minute here on the poll and then we'll end it. So here's what I want to look at. Let's look at some of the positions that we have going on right now. And so let's go over to the monitor tab and look down here. We have the JP Morgan trade, which I'm going to spend a lot of my time talking about this. This thing's been bouncing around all day long. It's been kind of annoying to watch. The KDP trade, the NVIDIA is not part of it. Oracle and Tesla are the last two we talked about. These have really taken off. Let's ignore JPM for just a minute. Let's look at KDP. And that one, we had a 29.31 call. So this is a short call spread. We were looking for it to be below 29 by June 18th. And so if we go to the chart and take a look at that, let's see, do I not have it on red on that? I guess not, huh? Okay. We just put in KDP, hold that one up. And we're looking for it to be down here. Now, it popped up. It gave a little bit of a surprise, getting above that resistance level. Not quite as high of a rally. Now, maybe it's not done yet, but it hasn't reached the old peaks it had right there. And so I'm looking at this saying, okay, does it have potential to come back down within that time frame? And obviously, from a chart standpoint, we can see that it can come back down. Let's actually look at this in another way too. I want to go and click on the Analyze tab. So if I'm going to right click on that and come down to where's my analyze? Oh, no, don't have. Let's try again. Let's try right here. Analyze. Come on. Oh, you know what? We're just gonna go over to the Analyze tab and do this. And show all. So I have the positions in there. We bring in KDP, and there it is. There's our position right here. So remember, this is a bearish trade, and so this position will actually make money as the stock decreases in value. And so once again, we have, the stock price down along here. So we want the price to be heading down. And then this shows us our profit loss. And so this is where we make max gain is right here. Here's when we hit max loss. And then we have some sort of max gain, max loss, somewhere in between, a break even in between there at some point, right? So with that said, one thing to always make sure that we have is that down here where it has the expiration, make sure the up here it matches that, like it's always the day after that expiration. So it is there. This is the June 18, and that's we've got June 19th, and so we're good to go there. Now, as we look at this, what we see is, in fact, we can move this around. Let's move this to max gain. Well, the max gain, we're still looking around what, about 30%, 31% probability of hitting max gain. So it has diminished somewhat. But what about max loss? We're still well off of max loss at 31. We're still at 71% of making some money. So with that idea of 71% of I shouldn't say making some money because the break even is over here, but not losing 100% of it, right? We have about 40% chance of making a profit on this trade. And so there's still some time in this. And so because we still have time, and these are time trades, we're going to sit on our hands on this, give it a little bit more time to come on over, okay? And see if it can't work its way back into what we need. Let's take a look at the others real quick. We have Oracle. And on Oracle, we sold, which one? We sold the 185. This is a bull put spread or a short put vertical. So we sold the 185, need to be above 185. And then we bought the 180. Looking at the chart on that one, how come that's not coming up? It's weird it's not doing that. Well, but I'll just punch it in ORCL. So as we punch in Oracle, now this is one I talked about at the very end of the class last time, looking at kind of this breakout that we had, right? So we're looking at where was it? About right there. So it made a run up, it pulled back, it bounced, it broke through the old high, looking for a retest bounce, and that's what we saw is kind of bouncing up off this area, and it has taken off since then. I'm going to go ahead and remove these Fibonacci's. In fact, we could probably even just come in here and see if we can draw a trend line on that. That might be a little bit more accurate. Now, one thing to keep in mind when you're drawing a trend line, be very careful about drawing a trend line in between 2 points. You really want 3 touches, and that's what we have. We have this touch. Let's draw these out. In fact, these 3 touches. So it came down, it bounced here, it rallied up, it came down, bounced again, rallied up, and came down, bounced again. And so that gives us this 1, 2, 3 touches on that trend line right there, which, it's really important to have all 3 of those. Because 2 is just, you can draw a line between any 2 points in the world. We have to have 3 to kind of confirm that, all right? And so that one's still moving higher. So nothing to really be concerned about on that one. We just need some more time on that one to expire to make the trade work out on that. And if we look at that one, what is it doing? It's up what? It's up $142. So yeah, that's good. Another one that we have going on is Tesla. And Tesla, we sold the 405 put, bought the 400. So we're looking for it to be above 405 by June 18th. In fact, I should have put my charts, my boxes in there, huh? If we don't have it, we'll do it on Tesla. Oh, there it is. It's just Oracle. We didn't have it. But this one, we were looking at that Fibonacci bounce, the retracement down to support, and then a bounce up off that. And so right about there, we were just seeing this. We had this morning star, and this is actually an abandoned baby formation I mentioned. Going to those YouTube shorts, you go out to the YouTube shorts, I've actually put together, videos that are 3 minutes or less, not 30, 3 minutes or less, 180 seconds or less, talking about various candlestick formations. And I covered an abandoned baby and why that's actually even more, from a technical standpoint, even more significant than just a morning star. They're very, very similar in creation, but there's, from a psychological and a technical standpoint, the abandoned baby is a stronger signal. Doesn't mean either one of them are always going to work out, but that's just the way it's looked at from a technical standpoint. So we have that, and then we look to get in, just get the after we got that candlestick signal and taking a ride on that. It's doing really well. We'll look to possibly close this one out early if we can get to a pretty good spot on that with time decay and everything else eroding away. Right now, it's not there. If we punch this in, we still have about 93 cents. There's still quite a bit left in that. But from the Analyze tab, and we can look at the last two here. Here's our Tesla right here. Ooh, that's kind of scrunchless. Let's give us a little bit more room in here. Here's our Tesla trade. And so looking at making sure our dates are good, our dates are all good. So this is max gain. This is the opposite of the other one because this is a bullish trade. And the other one we looked at just a minute ago on KDP was a bearish trade. And so this one up here is where we have our max gain. And there is, whoops, I overshot it. There's our max loss down there. And then we have this, somewhere in between going up and down in there. Now, if we drag this over, so really our max loss, we're at about a 24% chance of about hitting max loss at this point. And if I move this up here, we have about a 73% chance of hitting some sort of max gain on that. So it's sitting really good, as it sits right now. But we'll let that one ride. And hopefully be able to close that one out early. All right, just making sure. Okay, Oracle looks solid. Let me go ahead and close that poll and see how that ended up. End poll. And seeing if I get results. So does Brett Shirt, here's the poll real quick. Does Brett Shirt have a Hawaiian or not a Hawaiian vibe? 62% said yes, 38% said no. Therefore, I lose. Bree wins. Gabe wins. Our producers win. I lose. I guess I have a Hawaiian vibe. So, all right, maybe I need to take some of you shopping with me. Well, anyhow, thanks for the fun of the poll. Let me just make sure I get all the questions in here, though. How do you think about gamma to theta about the KDB call spread? So gamma to theta, here's the thing about gamma. I'm not really worried about gamma at the moment because gamma is going to it'll start building up as we get closer to expiration, but there's still some time. And as long as it starts moving back, we're going to see the gamma actually work in our favor because then it'll actually move that delta and push all the probabilities. You're going to see that actually go from kind of more out of our favor to quickly more into our favor if it does, in fact, make that move in our direction. And then theta as well. So all that money that kind of was going against us then becomes, of course, it's kind of dumped from this loss over into this profit bucket if it does come back. Now, it does need the price action to do that. And that's where, the time is important to understand and how much time do we have in that. And so I'm not worried about it at this point. All right, just checking, make sure we got all the others there. Okay, yeah, we're good. All right, so those are the positions except for the JP Morgan. I wanted to hold off on the JP Morgan just to address this because we have two trades in here and I wanted to show each of those and showing, okay, what if we did this one? We did a 285, 280 bull short put spread or bull put spread that was, more of a conservative play, right? It brought in less income, but had a higher probability. Then we also did a 300, 305, which had a much lower probability, brought in a lot more income. Well, if we look at these, what we can see is they're actually performing, quite a bit differently, right? Like this one right here, this 280, 285, it's only it looks like it's up $3. We've lost $95 on one leg and made $3 or $98 on the other leg, so it's a $3 difference on that. Where if we look at the 300, 305, this one is down a bit, right? I mean, we're losing, get out of our way. We're down about $102 on that one. And so you can see they played out quite differently. And let's look at the Analyze tab on this one. And so I'm going to go over to the Analyze tab. I'm going to type in JPM. And what we need to do is I need to get rid of this right here, which is looking at potential trades. And we're going to click on the legs that we want. And so let's look at the 280, 285 put spread. And on that one, we can see this one's actually sitting in a pretty good spot. I mean, it's about a 70% probability as it sits right now of hitting max gain. Even a little bit better than that of hitting at least some money. And then, of losing everything, or hitting that max loss, we're only about 20, 21%. And so it's really looking good. And so this is the difference between selecting the strikes. Now, the trade-off on that was we didn't receive very much for that, right? In fact, I think we received, I think it was $1.95. Yeah, $1.95 for that. And so we could close that out for profit right now. But let's look at the other legs right here. And on this one, better pull this back a little bit so we can see it. This one you'll see is not quite as strong as far as a win-loss net, but I'll talk about the trade-off and the probabilities and all that here. So this one has a 32% probability right now of hitting max gain. And then we're going to hit break even somewhere in here about 37% and, you know, about 42% of hitting a max loss as it sits right now. So this one needs some love. This one needs the stock price to move somewhere in our direction to make it. But what was the trade-off? Well, the trade-off on this was both these are a 5-wide spread. All right. So the one the one we did in the money or more out of the money, we received about $1.95 for that, but so we had on that one what's $5 minus $1.95? That's going to be what 305. So we had $3.05 of risk per share, or 305 per contract, where the other one we received 250. And so there's a $250 loss on that one. So we received more income on the one that had less probability. And so we need the stock to move more in our direction. And as long as it does that, we can make more, but it's not as likely to work out. And so this is where you kind of got to balance, that probability versus profitability, right? And in this case, it's showing us that a little further in the money is in fact working out if the stock doesn't move the way we wanted it to. And I want to come back to the idea that when I was putting this on, a lot of you were saying, Brett, that stock, the chart does not look great for a bullish play. In fact, let's go out and look at that. So bring up JPM. This does not look great. We were just talking about it, possibly coming back and doing a bounce off support. And that was about 2 weeks ago we got in on that. So about the 14th. So it was right here. And it wasn't, it was just kind of sitting back at that 50% level, but we weren't seeing a bounce. We weren't seeing a lot of energy come into it. And that's what you guys were all saying. And so we did have a nice pop where it ran up for a little bit, but then it, came back down. And this is what's creating the loss in the last 2 days. It actually was doing fine. And so this is where you feel like the champ if you're doing the 305 or 305 300, but when it comes back down, then you feel better about doing the 285 280, right? And so it's just interesting to watch those two play out. Now, since the 285 280 is kind of is doing okay, we just need to let it kind of expire. I mean, right now if it just goes sideways, that one's going to expire with all the money. We're fine there. Let's talk about the other one. All right, let's talk about what we could do in this situation. So what I want to do is actually I want to take this trade and I want to move it. I want to move it out of here and just move it into the short verticals just so we can get it separate from everything else and not worry about all these other positions, especially the one on JP Morgan. Now, what we have here is this position is down about $100, right? 102.50 is exactly, kind of more where it's at right there. If we close that up, we can see this. But it's basically down $100. And so, some people will say, well, go ahead and just roll it. And, then you're fine. Well, we could do that. And what would it take to roll it? Well, all that we need to do to roll it is right click on this. And from there, you can just see if we scroll down just a little bit, it's going to say create rolling order right there. Now we can roll the entire thing or we can roll different legs about this. Now, what is a rolling order first off? Well, a rolling order is basically getting out of this one and getting into a new one. And it's just going to put it all together in one trade. And so let me click on this and say, okay, I'll go to this one. And this is what's happening. This is our initial trade. Let me try to highlight this. I wonder if I have a box in here I can draw. Yeah, let's draw this box. Now let's make sure it doesn't disappear. So right here, here's our initial trade, this right here. All right. This box a little bit thick in there. We don't want it quite so thick. But this is our initial trade. And so just above that is going to be the rolling order. So this part right here would be the new position. Oh, that was weird. I guess I went off the screen, so it created a new box. But right here is the new position. All right. And so what it's doing, you can see it's actually the same thing. We've got 305, 300, 305, 300. But this is actually saying get rid of the June 18 and go out to the June 26. So it's basically popping it back a week. All right. That's all it's doing. And this is saying it's going to cost us 53 cents to get into that trade. You see it says 53-cent debit. Ignore the subtract there. It's just going to cost us 53 cents. And you can always confirm that. Let me get rid of this just by hitting on the confirm and send. And it'll tell you, if it's going to cost you or not. You can see right here, $53 to roll that order. And so it's going to cost us some money to move it out a week. Well, A lot of times people don't like, they like to roll for a credit, right? And let me show you how we're going to do that. All right. But just before that, let me just check and make sure. It looks like we got a lot of things coming in here. Speak Truth. Let's see. Um, Tesla, SpaceX, Elon Musk, and induced intense short-term trading. That's, yeah, very true. John List, do you monitor IVs when entering, or do you cancel, or do they cancel out? Um, Implied volatility, generally speaking, it's nice to get in with higher implied volatility. It's just the getting the technical aspect is a little bit challenging. But it is nice to get in because if you can get in, you'll sell it and get a little bit more premium off of those legs. But generally speaking, the higher implied volatility typically will come up when we're looking before an earnings or something. And so from a technical standpoint, or even like a newsworthy, it just makes it a little bit challenging. All right. Hey, Mickey, good to see you. All right, so let's come back here. And what I want to do is actually lay this out and just make sure we have, because the best way to kind of understand this is to walk through it step by step. And so with this JP Morgan, what we had was a 305/300 put spread, right? And on that, we sold the entire thing for $2.50. All right. So our risk on that trade was $2.50. Now, how is that? It's a five wide spread. It's $5. So the risk on that trade is $5 because basically someone could put the stock to us. If the stock dropped down, someone could put the stock to us. We have to buy it at 305, but we have the right to sell it to someone else at 300. So we'd lose $5, but we'd keep the 250. And so that means $5 minus 250 is a risk of $2.50. Okay. And so if we were to go close this trade out today, if we're going to go close it out right now, let me just see what it's going to cost. It's going to cost us about 353. In fact, we're going to just say it's going to be about 350 to close that trade. Okay. So closing it costs $3.50. And so we lose about $1 on that, right? And that's our $100 loss. That's what we see right here, right up here. And it's kind of bouncing around. You got the midpoint, but there, you guys see where we're getting this $100 loss from? Sold it for $2.50. We'd have to buy it back for $3.50. So that's 100, or $1 or per contract, $100 per share. And that's all we have is one contract. Everyone on the same page with me? You all good? Want to make sure we understand as we walk through this because it's going to get complicated real quick. All right. And then, all right, good. So let's do this now. Let's go back over do we still have that trade on there? No. Let's try that again. Let's go back to the monitor. We're going to roll that order, create rolling order right here. Okay, here's what we want. Now, this says a 30-cent debit. Now, why does it say a 30-cent debit? In fact, let's actually try to change this to a credit because I think they'll help us walk through that a little bit easier. So one thing that we could do is actually go up a little bit in strike prices, which would create a bigger income on this. And so instead of just going out to the 26, what we could do is sell the 310 and buy the 305. And so we're actually rolling out and up. And this one is pretty close to zero. It still says 3-cent debit. I'm sure as that bounces around, we're going to see that change a little bit. In fact, I was doing this earlier and it was going from negative 3 cents to 0 to positive 2 cents and back and forth. And so it's basically a wash. Now, so what that's doing is it's taking $100 and it's saying we're back to break even. So why don't we just do that? Sounds like a good game plan, right? We're back to break even. We're just going to get out of this trade and get in that trade, and it's not going to really cost us anything theoretically, right? But that's what I want to walk through is kind of there's a step in there that we're missing. And so let's kind of go into the new trade. Let's get this out of the way. We're talking about a June, what is that, 26. So maybe we should put in here just to keep them straight. This is the June 18. The June 26, 310/305. And this says it's not going to really cost us anything. I mean, we're just going to get into that one. Just kind of move on over to it. But that's not actually what's happening here. We have this $1 loss or this $100 loss. What happens to that $1 loss? Well, let me show you. Let me show you. Let's get rid of this. We're going to go out and just see what it takes to place that trade. If we were just to go out and get into that, we're going to go out 26 June. We're going to go out and we're going to sell the 310 right here. So I'm going to click on the bid price and then I'm going to go back. Come on. Boy, that really scrolled up a lot. And we're going to buy the 305. So I'm going to hold down my shift key and click on the ask price of the 305, and that's going to create our 305 310 trade. All right. And that says that's going to give us, we still have the right week, about a 335 credit. A 335 credit. Now what's going on there? What's going on there? So this one would give us a credit of, of $3.35. Okay. Well, the prices are moving, and so what would happen is I think this other one has probably dropped a little bit. But let's go back and just check on the other one, because this one, if we were to close out our initial one, I bet you it's changed. Create closing order. Yeah, 338. So it was 350, but now it's 338. Okay, are you seeing where that 3 cents is coming from? You see where that 3 cents is coming from? So what's happening now is prices have changed. So let's just run with this. Is we sold it for 250. We'd buy it back for 338. It costs us $3.38 to get out of that trade. But if we roll it, it's going to be zero. And so, but what's happening here is what we're taking is the credit of this new trade, that 335, and we're using it to pay for the close of the prior trade. You see that? So now we say, okay, well, then what's the risk on the trade? The risk on the trade then is if we just add this all up. And so if we bring in $2.50, so let's bring, we have a plus of $2.50. We have a plus of, what was the other one? 335, that credit. $3.35. That's going to give us what? Get rid of this. So 250 plus 335 is going to give us 585. Okay. That's the total credit we received from those two trades, 585. But then we take that 585 and we have to minus out what we had to pay to get out of the one trade. So we take the 5.85 and we minus off the 250. And what is that going to leave us with? 585 minus 250 is going to give us 335. Did I get that right? 285, 335. I missed something in there. 250. We got the credit 250. Oh, hold on. Sorry, I'm sorry. I messed it up. I didn't do. It's not 250. What am I doing? It's not that. It's the pay we had to get out. That's where I'm off. Sorry. The 3.38 is what we paid to get out. So 585 minus the 338, and that's going to give us, there we go, basically back 250. That's what I wanted. It's like, that's off. All right, so here's the deal. So essentially, we're back into the same trade again. We're into a trade where we have this credit of $2.50. And so what's our risk on the new trade? But now what we've done is we've bounced it back a week, right? Remember, we're in the June 26th, 310 slash 305. Basically, when you add and subtract all this together for a credit of $2.47. That's almost what we had in the beginning. And so you say, well, why wouldn't we do that, right? Because we were losing $100. Now we're kind of back in the same spot. Well, what happened to our probability? Remember, we had to change that. We had to change that. Now we got to go to a 310. The price has to be above a 310 at expiration to make that work out. And let's try this. Let's just change these prices to, let's get that June 26. We're going to go with the 310, 305. And I want to analyze that trade. Let's make sure we don't have our prior trades on there. There we go. All right. Do I have that right? Oops. No, I have those backwards. We're selling the 310. Let's switch those. There we go. Selling the 310, buying the 305. There we go. Okay, so look at what's happening to our probability. What's the probability of this working out? Is 25% of us making max gain on this, right? 25%. 25% versus what's the trade that we have right now? It's this one right here, 300, 305. Let me take that one off. Actually, that's not a bad one. 31%. We have a 31% making max gain. This one can make sense to possibly roll. And so in this case, we're giving up about 6 cents or 6%, 6 points worth of probability to actually get to make it there. And so this is a time where it makes sense. But a lot of times what I'll see is people will roll trying to get a credit, but what they're doing is they're taking the next trade's profit to cover today's losses and reducing their probability. Now, here's one thing I really want to address on this, and then I'm going to get to all your questions on this, because I'm telling you this, I know these are kind of tricky in our mind to understand. So there's two things that we could do here in order to roll this trade. One, we could create a rolling order. We could get out of this one, and then we could go enter the other one. All right. And by the way, if we got out of this, we'd pay a commission on each leg to get out, and then a commission on each leg to get in. So we have, 2 commissions to get out and 2 commissions to get in, and 4 commissions altogether. Or I could create a rolling order and just do it in one trade. Just going with that 310, 305, right? And I could just do it in one. The prices keep bouncing around, but I could just hit confirm and send that off. Now, we'd pay a commission on each leg. So 1, 2, 3, 4. So here's my question. What is the difference between rolling versus getting out of one trade and getting into the other? Mickey already knows where I'm going with this. I want to be very clear here because this is a concept I really see a lot of people not understanding. Like, well, I'll just roll it. Right? And the answer is, it's going to pop up here in just a minute on your chats. There is no difference. It's the same thing, whether I just go ahead and close the existing order and then enter a new one versus roll it. It is the same thing. My point is there's nothing magical about a rolling order. And what Mickey said is often very true, is like sometimes it's more clear just to exit one and get into another one so you don't get all this, it can kind of get mucked up and it gets challenging saying, okay, so what did I have that first one? What did I sell the first one for? And then what did I get out of it? What was the loss? What was the credit I got on the next one? Where does that leave me here? It kind of can become very confusing. And so, yeah, you guys are great. Yeah, you guys know it. There's no difference in that. And so the couple things I just want to stress is be careful about rolling. In fact, let me just show one more example on this one, okay? Let's say we were to take this out instead of just let's delete all this. Let me try one more thing on this just to kind of drive home this example. So again, I wish those prices, this would be nice if we were doing this after hours and prices weren't moving. But again, right now I could close that out for 330. Let's go ahead and try rolling it. But this time I'm going to push it even out further and up. And so we're going to go to a July. So we're going to get more time. So there should be more premium in there. And I'm going to still go up. And hopefully, let's see what we get for this, a 310, 305. Okay, now we're getting a 27-cent credit on this, right? And so that sounds like great. Why don't I just do that? Why don't I just go ahead and roll up for that, a credit of 27 cents, right? Well, this isn't just magical. This money isn't just coming, from nowhere, right? The problem is, where is that 27 cents coming from? Well, again, we sold for 250. We're getting out at 330, so there's an 80-cent loss right there. All right, so maybe we should put that in here. Loss of 80 cents on that first trade. And then let's go look at the new trade just to break it down leg by leg. we go out to July 2nd, and we talked about selling the 310 and then buying the 305. So I'm going to hold down the control key, the ask on 305, and there's a 357. It's kind of probably bouncing around here. We'll just move that 360. Buy that for 360. All right. So as we do this, let's get rid of all this since that's the other one. All right. So we got out of that one with lots of 80 cents. We're getting into this one with a new credit, but if it costs us, the 330, we got the 330 kind of coming off of that 360. That's what's covering that one. And so we have that 30 cents, and that's what we saw earlier was that 30 cents in there, so because we were losing. So remember, to get out of that trade, it's going to cost us $3.30. But then if we bring in, so this is the easiest way I think to show it. Oh, if we bring in that 360, then that equals a loss of, what is that? 30 cents, right? So initially we had a credit of 250, but we're getting, if that's where we're ending up with that a difference of 30 cents, then we're down to 220 is what our credit is. So what happened is we took that loss, we kind of rolled that in the next trade, and then now our risk just went up. So it looks all nice and pretty. It looks like, hey, we're making money, but really, in the end result is we're how to explain this? We're just buying some time. We're taking tomorrow's profits to pay off today's losses, is what it is. And so don't think that just when you roll it, that it's just looking nice and it just is all just free money, because it's not. You're changing your probabilities, and you're oftentimes it will reduce the potential profit that you can make, because you're using what would have been profit on that trade to pay off the loss on the existing trade. So there's a lot to talk about with those rolling orders. The things that I really want you to walk away from this understanding is basically there's nothing magical about a rolling order. It's simply closing out of one trade and getting into another. It doesn't salvage anything. It simply is taking tomorrow's money and paying off today's and hoping that tomorrow's trade works out a little bit better, right? And so it's not bad to do it. It's not good to do it. It's just making sure we understand what it is. So let me just check some of your questions and we'll wrap this up. Okay, the rolling order is easier because you don't have to back out of the other spread first. Yeah, that's fair. Rolling, good to understand. Calendar and covered call traders may like to roll. And it's fine to roll. It's rolling guarantees a credit premium. If you choose close and then try to reopen an order, you may not get the same credit you were expecting due to timing of each trade. Now, one thing I want to say about rolling orders also that can be challenging, though, is because you're now demanding like all four of these kind of work out, sometimes they can be more difficult to fill too, because you're looking for it on all four legs. Let's see. Borrowing from Peter to pay Paul. Yep, that's right, Mickey. Let's see, where else are we? Is there a way to see what the price? Is there a way to see what the price of the new spread needs to be in order to make the profit after the roll? Seems like closing and opening may be less complicated. Yes, and I mean it's simply just looking at like when I did that one, the quickest way to see what you need to do get it for is just do create a closing order, right? And it's 295. That's the credit you need to receive to kind of wash that out. So you need to get at least 295 on the new one. Let's see. All right, I think we got them all. Okay, well, hey, last thing is I am not going to be here next week. I'm not going to be here the week after that, or the week after that, or the week after that. Now, yeah, I'm still employed here, but I'm going on sabbatical. And so I'm not going to be here for a bit, so we're going to have Connie and some other coaches fill in for me. I appreciate uh, them helping out while I'm gone. I'm going to miss you all through the month of June, but I'll be back in July. And so part of that is I actually am going to be sailing around the Bahamas for some of that. So three other couples. My wife and I are going down to the Bahamas. We rented a boat. One of them is a certified sailor, and we're going to go sailing around in the Bahamas. So I guess it matches the shirt, huh? But thank you for joining me today. Thank you, Kevin, for taking care of the chat. Appreciate you being here. And I look forward to seeing you down the road. Until then, take care.